Principles of Finance, a la Shmup. Debt as Porridge. When is Goldilocks happy? Deep Thoughts by Shmup. There is greed and there is fear. They wrestle, they breed. And when they produce private equity investors. Okay, people, strap yourselves in. We're going to do a lot of debt math here. Don't bother trying to be precise. Just be in the zone and follow the concepts, the biggest of which would be the concept of what is, quote, too much debt, unquote. That's, quote, too much, unquote. Like, how much debt can or should Blade Runner Nanodrone be able to handle? What determines that debt amount, that max debt? What's the upside? What's the downside to pushing the debt envelope, its limits? Well, for starters, let's review our base case working model here. That is a really simple summary income statement with a hint of cash flow and a dash of balance sheet. And here we go. All right, we're looking through all this crap. Revenues, operating, gross margin, expenses are here, total operating costs, net margin is probably here, interest costs will be here. All right, we're done mumbling. Well, the big numbers that need to stand out here are the cash earnings. GAAP, or notional accounting earnings, don't pay cash back to lenders. Lenders just want to loan their money, get the interest annually, and then get the principal paid off at the end and play golf. Lenders are usually awesome golfers. This model just rule of thumbed and added back depreciation and amortization to calculate a very rough proxy for what cash flow would be. Note that the model ignores interest income from the cash, and the big challenge here is to back out an EBITDA number, which is a bit harder to peg because operating profits have been all over the map, and you need an estimated steady-state EBITDA number that is conservative, especially when you go to lenders, one where you can swear up and down to the bankers that you'll hit it and that it will drive the return of the loans on the debt that you're promising all of them that you'll pay back. And in practice, on deals that really push the edge, these EBITDA minimum promises from company management are a really big deal. In some cases, if the EBITDA numbers come in below the promised minimums, all kinds of bad restrictions then happen to the company in the form of the lender being able to exert way more control over the company operations than the management wants, and basically then lenders starve the company for growth capital and just move all the capital to paying back the loans, and they don't really care what happens after that. Welcome to the real world. And more often than not, lenders will become short-term greedy rather than long-term, as their interest lies solely in getting their money back. That's the banking beast. They don't really care what the equity value of the company will eventually be. Often they participate in only a small way in that upside, if at all, in the form of those warrants they get when they loan the money. And all that's part of the LBO process. Well, having now spent 487 hours looking through every facet of the company's filings, you feel pretty confident that you can generate 5% more revenues than the company currently projects while cutting expenses 5%. Not heroic moves at all, but combined, they're meaningful. It's a 10% combined delta or change with very high profit contributions, and small projected moves like these are in fact believable to banks. Well, the company doesn't need to do a 30 and 30 move to make the numbers work. So if you can 5 and 5, you might be off to the races. Recall how you calculate cash flow. You start with GAAP net income line here. This line was earnings, which was $83 million in the last year. Then you add back depreciation and amortization of $15 million here, because while those are accounting expenses, the cash paid for them has already gone out years ago. Maybe it was last year, maybe it was 5 years ago, doesn't matter. The cash was already spent, paid out to buy whatever CapEx that bought. Those are then just being depreciated through the income statement year after year after year until they're used up. Okay, next non-cash thing to think about, taxes. Well, you add back the taxes of $32 million. Why? Aren't taxes paid in cash? Well, yes, but taxes are likely only a dim glimmer in the past for this company. When the company has tons of interest expense from the layers of debt it will take out, those cash taxes will likely all go away, or at least down a whole bunch. Anyway, all combined, you get a rough cash flow number of about $130 million. If you tweak things a bit, you could get to $145 million, maybe $150 million, sure, not asking for miracles here. You note that the stock of the company is currently trading for just under $50 a share. There are just over 20 million shares outstanding, so conveniently the market cap of the company is a shade over $1 billion. To be fair with comparisons, you have to back out the enterprise value though. That is, you have to subtract the cash so that you can value just the ongoing business enterprise here, i.e. the business of selling 2 flavors of drone. So you subtract the cash from this $1 billion market capitalization value, and that cash stands at about $450 million-ish this moment. And yeah, you note that each each quarter it's generating a meaningful amount of cash each quarter there. So with the cash subtracted from the market cap of the company at this moment, the enterprise itself is being valued by investors buying and selling that stock at about $50 a share at $550 million. That's $1 billion minus the $450 of cash they have in the bank right now this moment. Well, that $550 represents what the group believes is the future earnings power of this company, more or less, if in fact they even thought about it. And a lot of investors, particularly retail investors, who likely comprise a large part of this shareholder base, really don't do this kind of math. They don't think. They just like the drones. They're pretty in the sky. They're neat and cool, so they buy the stock. So you ask yourself, what are shareholders getting for that $550 million in equity value here? Well, they're getting a company that produces about $100 million in net cash each year under its current structure without any tweaking or leverage. That's almost a 20% free cash flow yield. Incredibly high in this environment. The overall stock market has something like a 4 to 8% free cash flow yield, depending on a variety of things, but way less, meaning that this company is being valued as cheap, at least on trailing metrics. All right, you got there to that 20% figure by applying the free cash flow yield fraction. That's $100 million divided by that $550 million. You know, the company generated $100 million in cash. The equity value of the company is $550 there, $550 million with the stock at $50. So you take 100 and divide it by 550 and you get 18+%. By the way, all that extreme rounding you're doing as you perform your calculations, that's because precision, at least at this stage of the game, is a complete waste of time. The stock price and the value of the company moves every second that the trading day is alive. Like it's not $50.00 all day long and all next week and all next quarter. The earnings change every quarter, driven by daily changes in sales and expenses and all that stuff. Same deal with all the other operating metrics of the company. So trying to be precise here is pointless. You just need to get the basics, the basic ideas, get them solid in your head. As the Kardashians said, the perfect is the enema of the good. Anyway, as you poke through these strikingly cheap ratios, you wonder why the company never bought back its own stock. It makes no sense to you. Like if they believed in their own business and they have clearly way more cash than they need to operate the business, why wouldn't they buy back like a third of the company and quote force unquote their stock price to go up? Like to buy 6 million shares at $50 a share each, well, that would cost the company about $300 million and still leave them with almost $200 million in cash on their balance sheet by the time they were done buying it back. And they'd still have no debt. And they're generating healthy amounts of net after everything cash now, like almost 9 figures a year. Were they able to buy back those 6 million shares? Well, they'd go down to just under 15 million shares outstanding, and everyone who stays a shareholder owns a fatter slice of sweet, sweet ownership pie. Why are they not doing this? Why not make it happen? Totally within their control, yet they're just sitting on their cash hoard. What could be wrong? Well, you jot down that confusing observation as a big question for the CEO, hoping you'll get that meeting soon. You start to actually put flesh on your financial model for this company and dial in the big pitch or presentation for why we should buy to your partners. Well, your first instinct is to want to offer $60 a share to buy the entire company for about $1.3 billion. You know the first offer never sticks, so you're prepared to go to $65 a share or about $1.4 billion. Well, what does that number look like for the new capitalization of the company? Well, by the time the deal's done, the company will have generated a bit more cash, so call it $500 million in cash on the balance sheet. You can use that cash as part of the purchasing of the company. It's an asset of the company that you're buying, kind of like buying the cow with her own milk as stored in the metal buckets around her. Thanks there, Bessie. Now you need to come up with $900 million in loans and or equity, and you'll be the proud new owner then of a future is questionable toy, drone, and battery company. If you tried to make this purchase entirely with debt, well, yeah, you'd need to be leveraged at 900 divided by 150 there, 115 EBITDA. That's 6 times EBITDA. Ooh, that's a really high multiple for this kind of volatile company. See the visual near the beginning of this video for details. That's what happens if you miss. But that's okay. Your firm is in a position to invest its own equity into this company, and in fact, that's the normal scenario. Private equity companies generally raise cash specifically for these kinds of leveraged transactions where limited partners give them high-risk money to invest as equity, hoping to get many times that money back in return. That is, your firm might use, say, $150 million of its own cash as equity, coupled with that $750 million, that'd be left from the 900 minus the 150 there, of debt from friendly, loving banks, both U.S. and non, and you muse about your numbers and look at, the first year out there. If you execute on the LBO and the firm owns 100% of the equity of the company, well, that's what that $150 million would end up representing. The newly bought and taken private Blade Runner nano drone will then have $750 million with, estimating here, 6.75% cost of debt. And let's say the company is flattish in growth, maybe a modest gain in the first year at $150 million in cash flow, with a large part of the delta being from cash going out to pay taxes to instead now pay interest to banks. Also note, and this is important, that we've just glossed over the depreciation and amortization and intellectual property lines. We just assumed that they were phantom, i.e. depreciating an asset because of accounting rules, not because the asset's really getting less valuable or depreciating. That may or may not be the case, but for now, you're going to believe that the battery factory was built for, a century of abuse. Probably a different kind of abuse there. S&M there, that's sales and marketing.